Wow, guys, today has been an absolutely wild day. Barron's is saying brace for more carnage. And literally within 24 hours of this posting, Bloomberg is reporting Pimco is walking away from $240 million of debt from 20 hotels. It does not matter if you have a great property that's performing quote unquote well, or if you have a bad property, they're all getting repriced across the board. And we're not talking about like 10, 15%. Like this is going to be 30% plus. And I'm going to explain why, because when you see it, then the Pimco article or the article in Bloomberg about Pimco might start making sense. Now, of course, all these guys, Pimco, Starwood, you name it, they're all building up funds to buy back all of this real estate when it gets repriced, which is pretty sleazy because a lot of this debt is commercial mortgage-backed securities that's sitting in 401ks, pensions, yes, your retirement accounts. So it's not like you're not getting hit on the chin with this, even if you don't realize it. You're taking some losses. Everybody's going to be impacted by this. But let's take a look at a few articles that I find just absolutely interesting. Pimco walks away from 20 hotels with $240 million of debt. Now, interestingly enough, the appraisal for the properties was cut by 16% in December. And so it was valued at $272 million, at least in December. And now they walk away from $240 million mortgage. Now we're going to come back to this, but let's go to the Barron's article where it says the great reset of property prices is underway. Brace for more carnage. There's more than $1.5 trillion of commercial real estate loans that will mature over the next 3 years. They go on to explain why, and you guys know a lot of this stuff, so I'm not going to talk about it too much, but the Federal Reserve was slow to react. They were slow to respond to inflation. Then they rapidly raised interest rates. Now commercial real estate prices have dropped 16%. Obviously the same as what we just saw in the Bloomberg. But here's what they're saying. They're saying, now brace for carnage. Well, why in the world would you brace for carnage after you've already lost 16%? A couple things. One is the Federal Reserve higher for longer strategy is keeping the 10-year yield above 4.5%. That's very important because if you're a buyer, you're going to want a return higher than 4.5%. This is problematic because a lot of sales were done at 3.5% cap rates back in 2021. Now, this may sound insane to you. Basically, a 3.5% cap rate is a 3.5% return. You think, man, why would anybody ever do that? Well, you got to understand, debt was super cheap. You could buy something at a 3.5% cap rate, and you were having double-digit increases in rents at the time. So it kind of made sense, kind of. Now, I say kind of because obviously double-digit rent increases is an indication of inflation, and inflation is an indication that interest rates will go up. So why people did this to the level they did on interest-only debt that would mature in just a few years seems a little bit silly. But the fact is that the 10-year treasury is now at 4.8%. Guys, we just hit a new high in the 10-year treasury, and now we're back to July 2007. That's just crazy. But the bottom line is that you can get 4.8% just by putting your money into a treasury. What it ends up doing is you end up expecting essentially a 6% return, about 1.5% of the spread over the treasury. Now, it's very important to realize it doesn't matter where the capital is coming from. It has to get or project or expect a much higher return than 5% coming from the treasury market, or they're not going to buy the property. Okay, so it doesn't matter how much dry powder is on the sidelines, it's going to get repriced. I know I've mentioned that, but it's very important because, guys, there's $1.5 trillion coming due. Let's go back to this article. It says interest-only loans helped commercial property boom. The one thing I want you to see about this article that's just absolutely shocking, interest-only loans are pretty much the standard in commercial mortgage-backed securities. In fact, 88% of commercial mortgage-backed securities issued in 2021 were interest only. And guys, just think about that. You're getting an interest-only loan in 2021, which is fine if property values are going up and your incomes are going up. But what happened? The brakes were slammed, property values are dropping, and income is actually very shaky and dropping in a lot of areas. But it doesn't matter if incomes are dropping. Why? Well, let's take a look at this JP Morgan chart here. This explains everything that I've been trying to explain all in one chart. I think it's fantastic. But essentially, you have a $100 million property in 2021, let's say, okay? And it's a 4.5% cap rate. Well, now that the treasuries have gone up to 4.8%, you should very reasonably expect on almost all properties, 6.25% cap rate. At least, I mean, a 1.5 above. Now, there's still some Class A properties that are in the fives, apparently. I think that's insane, but that's still what people are saying. They're priced in the fives, but whatever. 6.25 cap rate. Okay, what happens to the value of this property? It goes from 100 to 72 million. Now, that's a blow, but think about it. It doesn't mean you have to sell. Why would anybody sell a property if they bought it for 100 million, it drops to 72? They're not going to lock in a $28 million loss. It's almost a 30% drop in value. 30% drop in value. This is all the while the net income of 4.5 million stays the exact same. So this has nothing to do with the operating any different. As long as its operating income is 4.5 million, it drops almost 30% in value. But here's where the problem comes in. We have interest-only loans that are maturing. And guys, if you got a 4.5 cap with $65 million in debt, guess what? At a 6.25, you're only going to be able to refinance it for $46.8 million. That means you have to write an $18.2 million check just to refinance a property that was getting the same amount of income just 2 short years ago. You go from 65 million to 46.8. So when we go back to the Pimco article and we see why did they walk away? Well, it was valued at 326 million when the debt was originated. That was about a 75% loan to value ratio. So if the property's now 272 million and you take the same loan to value ratio, they would only be able to get a $200 million mortgage on this property. So they probably had to ask the question, do they want to write a $40 million check or turn this in and let it get completely repriced? And we know the answer to that. They decided that they were going to turn it in. Wow, guys, just wow. Now, because of this dynamic is happening, people are not going to be selling their properties unless they're forced. We are seeing a massive slowdown in transactions. Here, we're seeing that, look at the volume for 2023. It's so much lower than, really got to go back to 2011. Jay Parsons actually posted this too. He posted the apartment sales in the first half of 2023 fell to the lowest level since 2011, guys. And you can see it here. It's just so slow out there. So slow. Guys, they are hanging onto these properties for dear life. And one by one, this is going to happen. As these go through foreclosure, they'll all get reset on their prices. And once they get reset on their prices, you're looking at least 30% drop in value on most properties. Here's another picture of debt coming due over the next few years. You can see 2024 is going to be massive with investor-driven maturities, commercial mortgage-backed security, government agency, national banks, regional banks. It's all coming due in 2024. And believe it or not, even in 2023, October and November, that's where we're at. These are big months for commercial. These are big months for maturity. So it's going to get wild out there. Stay tuned. I'm going to be covering this. I'm going to be paying attention to this. I'm excited about this because honestly, I'm excited about commercial property. I think this is where the opportunity is going to be. If you're waiting around for a single family home to crash, it's not here yet. I would appreciate it if you find this helpful or informative. Please click the like button as it does help the algorithm. And with that, I hope you guys have a great rest of the day, and I'll see you on Saturday.